be the one of the most pompous event which happened last week actually, and not the week that just passed. It's a US-China summit. I'll share my screen and show like a couple of images to show how big and pompous it was. But I wanted to see like whether you have any opinion of a meaning of this meeting and what you've gathered like from these negotiations and how it will affect the world going forward.
Yeah, I can start, Barton. Um, yeah, obviously, you know, uh, the main reason for me, what the first impression I got why Trump went there, um, it was basically because of the topic of the very topic that we will talk in a few minutes, which is the bond yields. So you know who's the biggest buyer of U.S. Treasuries, right? So and you know that in the recent years, because of because of this kind of small wars, um, China has said, okay, I don't want to buy many more treasuries. Um, I want to buy gold instead. So I think the media can talk about other stuff, making deals, etc. But I think the main reason for Trump going there is to control the bond yields and kind of make some deals so that China continues to buy and make the yields go down. I think that's the main reason.
Hmm. That's
On
interesting
that
because
point,
I
sorry, Arthur,
sorry.
I cut you off. No, you go
No,
ahead. You go ahead.
no worries. I was gonna say, like I didn't actually look from on this meeting from this perspective, Mario. I looked more like on like executives, like who went. I was very impressed that the whole government, alongside the main uh, chief executives of the big companies, went there and they were actually negotiating with China executives in China. So it was both business and government relations negotiations. And in particular, like the things that I've gathered is about the NVIDIA chip sales allowance, which should so China has actually approved now NVIDIA chip sales. And Nvidia has now been lifted that ban, so they could boost their sales by potentially like 20 and 30 billion US dollars. But I didn't even think about the yields, you know.
Yeah, no, I mean that's all part of the ceremony and of all this. Of course, there are other deals, but I think it's all around this kind of bond thing. Because if you think about it, what's what's the thing that Trump cares more about? Like it's this the stock market, right? So he wants the stock market to go up. And what's the biggest risk for that? It's uh it's the bonds going up.
Hmm.
If the bonds they lose control going up, there's not gonna be any more rally on the stocks. So
Hmm.
um, so yeah, I mean, of course there are other reasons uh, for Trump to bring all the CEOs to make deals because China is also very interested in making deals with them and getting chips. Um, and but probably it's all part of the same thing. Like, okay, we make some deals, and then in exchange for that, uh, we buy you more treasuries, or we basically we buy more debt from you, and because of that, Trump, who is very smart, despite of what people say, uh, Trump can ensure that he has the bond market under control, and I think that's one of the most important things for him.
Two things, Mario. One, I'd just like to push back on what you said about, think about some of the names that have come, all the major CEOs of all the corporations, right? Why would you fly these people out, take them away from their daily duties if it's just for theater? So,
No, I'm
uh,
not saying it's not for theater. I'm saying that it could be part of the deal, right? So, there are lots of export controls at the moment by Trump, um, that he has put some barriers for China to not trade, for example, the chips. China has a lot of difficulties to get chips from, or not chips, but the top performance chips, for example. So Trump could play just these cards. It's like, okay, we make a deal with you. We bring the CEOs. We agree on relaxing these controls, and then in exchange, well, you buy me more bonds, right? I think it's not theater. Of course, there are other things, and Trump wants business to to thrive as well. Um, but the main reason for me, and that the main reason is not something that you can hear on the media, but it's there. It's to control the yields, and for that, Trump, of course, he brings the best, the very best, um, so that he can offer China deals that he cannot, China cannot say no. So it's part of. I think it's part of the deal. All of this.
so in summary, just so I've understood this, greater economic cooperation between the United States and China, for example, allowing China access to NVIDIA chips, is a sort of like a sweetener for China to keep buying US
Mhm.
Treasury bonds. And maybe if
Yeah.
you also just like expand for the listeners, why the bond yields rising is a problem for the stock market. If we go into that now, maybe.
Yeah. Yeah. We can go
I
through
could
that
show
now.
the slides with bond yields.
Yeah. Yeah. It's a very good slide. What you're showing now. Um, so so if you see, we come from an extraordinary low yield environment for the past 15 years since the great financial crisis. It's been extremely low because we didn't have an inflation problem, and that means that well, the bond yields naturally fall, because inflation expectations are lower, so people can,
So here.
well, there is more money flowing into the bonds. Um, but yeah, that's not the case now. We live in an environment of inflation around 3%, and there is no forecast or for it to go down anytime soon. Despite of what they're saying, they're gonna make that go down. That's not gonna happen, um, for various reasons. There's a lot of capex, etc. There's a lot of spending. Um, but yeah, what could happen if the bond yields go, like, if you see in the chart, there is a strong resistance
Hmm.
in around 5.5% is a strong resistance. And I think that's the key level that we need to keep an eye on, because if it goes above that, it could get very ugly. Um,
So
but yeah,
inflation is influencing like the rise in inflation because of like spike in oil prices now,
yeah,
right?
yeah, yeah.
Hmm.
I mean, that's one of the things. Oil prices going up, so inflation goes up. Um, Other things is that government spending is like huge,
Hmm.
so that contributes to inflation. Um, Capex. it's also huge,
Yeah.
especially on AI. So
Yeah,
you can
you
think of
tend the
of
hyperscalers
inflation.
again. Hmm.
Yeah, you can think of inflation like the aggregate spend in an economy. If it's high, inflation is going to be high, right? Because there is a lot of demand, and naturally the prices go up. Um, so all this is not gonna all these factors, they are not gonna stop anytime soon, in my view. We are not gonna go back to a low inflation environment like we had for the past 15 years, where the governments controlled their spending very much. You can think of the European debt crisis. There was a lot of government control on spending. Companies also, they got very careful on spending. Um, Oil was very low. We
Hmm.
are not gonna get to this environment anytime soon.
Hmm. What
Um,
about other countries' yields? You've mentioned other country yields in other slides. Do you want to talk about them? Are they also rising similar to the US, or like there's different
they are
situations? It's UK.
they are
Hmm.
indeed, yeah. Yeah. If we look
Maybe
at the
Mario,
UK,
Mario, maybe you can elaborate for our listeners, like why 5.5% is that key threshold that should be concerning.
yes, yes. And sorry, Elvi, because I didn't answer your question before, like why stocks, why stocks, or it's not good for stocks if bond yields go up. Um, I'll get there in a second because there's a very clear example in the 70s for that. But the key for the US bonds, if they go above 5.5%, is that there is a strong resistance um, since the 90s, if I remember correctly. There's strong resistance there. And by technical analysis, this is a key level. So, um, there's a technical analysis and support and resistances. They are they tend to work very well on the charts, and especially if these supports and resistance they have been touched several times and even more in a long period of time. So that indicates that these are key levels for traders.
Yeah.
Um,
I'll add to from my position as well, like from a classical economical standpoint view, from like economics 101, the yeah, oops, just have to be mindful of time. Yeah, from classical economic standpoint, we basically have like when it comes to government yields, treasury yields, bank deposits, if this rate rises, the general public population investors are more incentivized actually to put their money into savings rather than the stock market. So it drives the demand on stocks in a direction of savings. So less capital, less money flow is going into stocks, and more capital is going into savings and treasury yields. And obviously, this affects the stock market and can drive the valuations lower.
yeah,
So
and
based on that, Arthur, is it fair to say then that there are maybe incentives to always maintain treasury yields, even maybe artificially low, in order to keep the stock market pumped very high? Is that
In
what's been going on since the great financial crisis in summary?
Yes, yes. In a lot of situations, yes, and this is what governments across the world have been trying to do. So obviously, again, it's like a different school of economics. There's classicals, there's neoclassicals, monetarists, Austrian economic schools. But in a summary, yes, like when we have a period of crisis of a contractionary economy, shrinking GDP, the governments tend to incentivize, stimulate the economy, and this is done by lowering interest rate. which should drive money out of savings account, out of treasury yields into the real economy. So that is consumer credit, giving more mortgages, and also people investing in stock market. So unfortunately, the governments have been trying to stimulate the economy for too long. They've been printing money. They have through the QE procedure, they've been buying government obligations, bonds, and as a side effect of that, like we have a rise in inflation, and the rise in inflation can only be stopped again by more cost of capital, higher yields. So it works like slightly counterintuitive, and the economic contraction and expansion, it's a very subtle process, and it can take years to fix one thing. And once you fix, let's say, inflation, you may have lower in economic growth. And once you fix lower in economic growth, you have good economic growth. You can have inflation or like a high unemployment. So all like unemployment, inflation rate, GDP growth, trade deficits. These are all like key components which governments should try to manage, but they haven't been quite effective in doing so ever since the financial crisis.
Yeah, there are also several ways of doing that. Like you said, Barton, usually mm, left-wing governments, they try to stimulate the economy by increasing the government spending.
Mm,
Um, but that unfortunately doesn't tend to work very well, and it doesn't really make the economy grow as much as lowering interest rates. But which is what right wing usually do.
mhm,
Um, so yeah, there are different policies there to stimulate economy, things that can be done better than others. Also, inflation is the main problem to stimulate the economy, because if there's a high inflation, there is little room to stimulate the economy, because if you stimulate the economy, the inflation will run higher.
yeah.
Um, so yeah, there's very subtle things in there.
Yeah, yeah, yeah. It's just like quite hard to fix it, and I can see the slides. There's quite a few countries yields presented in this presentation, and
Yes.
they're like all country yields are going up basically, right? Right now,
This
Japan,
ja this
Italy.
Japan chart is self-explanatory. Like
Hmm.
it's growing exponentially.
Hmm.
Um, it so if you look at other charts of other countries,
Hmm.
inflation took off in 2022. Uh, like uh, it grew a lot in
Hmm.
that year because of the oil prices spiking. The media would say Ukraine war, but it had nothing to do with that.
Hmm.
Um, and uh, and
I'd say
but
it
if you
was
look at
more
the Japan,
post-COVID, like post-COVID
yeah,
consequence basically
post-COVID,
of high money printout QEs across the world, quantitative easing.
exactly,
Mm.
exactly. They printed a hell of a lot of money, and then it showed up in 2022.
Hmm.
Um, but for Japan, it happened a different thing, because if you see, inflation took off from 2023 and
Hmm.
even late 2023, which is very weird, right? Because Japan is also an oil importer, like
Hmm.
most of Europe, and not the US, but most of Europe. Um, so yeah, basically oil didn't have too much influence there.
Hmm.
Um, so yeah, and right now it seemed like in the years after the financial crisis, it seemed like Japan, it would never have high inflation, but now uh, high inflation and high bond yields both are correlated.
Yeah, yeah,
But
yeah.
now that I mean, you can see the chart, the
Hmm.
10-year yield of Japan debt is like almost at 3% now. You wouldn't say that. It was impossible to imagine just 5 years ago.
Mm.
Is
But
there
yeah,
anything you guys maybe want to mention about how the rising bond yields for Japan at the moment might impact the yen carry trade? What should investors be thinking about that?
sorry, impacting the.
Yen carry trade.
Oh, uh, oh yeah. Well, the yen carry trade for the listeners is when some big institutions borrow money at very cheap rates from Japan. Then they converted this money. They bought, for example, dollars that had high interest rates, and they put it in a basically bank deposit in the US in dollars, so they could get like a safe interest. Yeah, that's a good question. Uh, I would imagine that this doesn't happen anymore. This happened when the interest rates were extremely low in Japan. People also, I know some people that, some banks that offer mortgages in Japanese yen as well because of the same reason, because the borrowing rates were very low in yen. But yeah,
Those were
that's not
banks
looking good.
in Europe or America? Which country are you talking about?
Um, Banks in Europe,
Yeah.
at least in Spain, there were a few banks. It was not an easy process, but I remember some banks, if you ask them, they would do it. Yeah. But obviously that's not a business anymore. And those that had these carry trades, uh, I guess some of them they got burned. Looking at the yields, yeah, there's not anymore near zero interest rates in Japan. Interest rates right now, they are closer to 3%, which are similar to those in Europe and those in the US. So there's not a business anymore on the carry trade.
Cool. Let's resume for second recording because time is off for this one.